Hey, it's John from StopSaving.com, and welcome to the next video in our course about Technical Analysis Simplified. In the last video, we learned how Bollinger Bands can make it a lot easier to trade W-bottom patterns. Well, it's the same thing with M-tops. So let's learn how to trade M-tops with Bollinger Bands. So here's what you'll learn in this video. Number 1. How to use Bollinger Bands to confirm true M-topping patterns. 2. How to use the Bollinger Band %B indicator and the Bollinger Band width indicator to help you trade M-topping patterns. And finally, number 3. How to manage risk when trading M-tops. At this stage, you're probably wondering why Bollinger Bands help us with trading M-topping patterns. Well, as I'm sure you've guessed, it's the same reason they help with W-bottoms, but the opposite. The first high typically happens with extreme euphoria. That means high volatility, wider Bollinger Bands, and the high is generally above the top Bollinger Band. In other words, it's an extreme move. After the first high, dip buyers come in, but the euphoria dies off and investors get complacent instead. So the second high has lower volatility, narrower Bollinger Bands, and is closer to the middle band. In other words, it's a less extreme move than the first high. Let's now see this in action with the Brent crude oil 1-week chart. As you can see, the first high was essentially a blow-off top. Notice how the price wicked way above the top Bollinger Band, but still finished in the red by the end of the trading week. Clearly, the smart money would have taken a lot of profit here, and the dumb money would have been buying in as oil prices went vertical and euphoria was at its peak. Then the price came down, and dip buyers stepped in. This might have been a good time for a shorter-term trader to buy the dip, but for long-term investors, not so much. The price did go higher after this, but it then made a second top. The second top was on lower volatility than the first, as shown by the Bollinger Band width indicator in green. This was a sign that buying pressure had slowed down, and instead of a euphoric buying frenzy, buyers now became complacent and sat in their positions, confident the price would keep going up. Meanwhile, sellers are generally unloading their positions, and they gain full control when the price makes a second top. Now look at the Bollinger Band %B indicator in orange. This was at a lower point on the second high than it was on the first. In other words, it was a relatively lower high versus the middle band, or 20-week simple moving average. Another sign that the trend was about to shift in favor of the sellers. And as for how to trade this, well, you could have sold or taken profits after the second high looked like it was forming. For example, after this red candle closed. And if you were looking to short Brent crude, you could have gone short at that point too, and then set your stop loss above the spike high of the second top. Now, sometimes M-topping patterns aren't quite as clean as the one we just saw. For example, this one on the US dollar index 1-day chart. High 1 was a bit of a blow-off top, as the price moved outside the top band and then quickly closed back inside it. High 2 was a lot slower as complacency kicked in. The price then made another high with even more complacency. Notice that each successive high had lower volatility, i.e. narrower Bollinger Bands, and was a relatively lower high in terms of its distance from the 20 SMA. Technically, the right time to go short or sell out of the DXY was when it looked like a second top was forming, as you just don't know if there'll always be a third top. And since you'd set your stop loss above the spike of the second high, you wouldn't have got stopped out of your trade when the third high was forming, in this example anyway. So here's another M-top example for silver using the 1-day chart. High 1, a more extreme move. High 2, a less extreme move. See, high 2 had lower volatility than high 1 based on the Bollinger Band width indicator, and it was a relatively lower high based on the Bollinger Band %B indicator. So, you could short or sell after the second top looked to be forming, and you could set your stop loss above the wick high of the second top. So we've covered the head and shoulders pattern in a lot of detail in an earlier video on M-tops. Well, here's an example of a head and shoulders pattern on Avalanche's AVAX token for the 1 week chart. Here's the left shoulder, then the head, and the right shoulder. Notice how the Bollinger Band width indicator went down with each successive high as volatility went down, and how the Bollinger Band %B indicator went down too. In other words, each high was a relatively lower high than the one before it. So technically, you always want to try going short or selling when the second top looks to be forming, again, as you don't know if there will be a third top. And as always, the stop loss goes above the wick high of the second top. Bollinger Bands can also help you spot potential bull traps, and here's a prime example of one on the Bitcoin one-day chart. There's the M-top pattern. Here, the second top did happen with lower volatility, which is what you usually want to see with an M-topping pattern. But in terms of its relative position on the bands, we can see that the second top was actually a higher high than the first. In this case, look at the second top in isolation. Notice how the price quickly spiked above the top band, but then, shortly after, it closed a red candle back below the top band. This was a clear indication that a lot of selling took place after Bitcoin broke above the top band. And while it might have seemed risky at the time, braver traders would have gone short here and set a stop loss above the second high. So to wrap up this video, here's a summary table of what we've learned about M-tops and Bollinger Bands. Typically, you want the first high to be higher in terms of its band positioning. This would usually be high above the top band to signal an extreme move, or further above the middle band or 20 SMA than the second top. You'll also want the first top to have higher volatility. That suggests the move is more euphoric and more volatile than the second top. As for the second high, you'll typically want that to be lower in terms of its band positioning. This top might form below the top band or closer to the 20 SMA. That means it's a relatively lower high compared to its distance from the 20 SMA, even though the price might actually be higher than the first high. As for the volatility of the second high, it's often more bearish when that's lower too. This shows slowing buy pressure as investors get complacent after buying the first dip. So that's the end of this video, and here are the key takeaways. Number 1, Bollinger Bands can help you find better M-top trades. 2, you want the first high to be on higher volatility with wider bands than the second high, i.e. you want there to be more euphoria on the first high than the second. 3, you also want the second high to be a relatively lower high versus its distance from the middle band. It doesn't matter if the second high actually looks higher in the chart. 4, use the Bollinger Band width indicator to compare the volatility of the first and second high. 5, use the Bollinger Band %B indicator to compare the distance of each high from the middle band or 20 SMA. 6, you can sell short when the second high looks to be forming and set your stop loss above the wick of the second high. And finally, number 7, take some profits if or when the price reaches the bottom band if you prefer. So that's everything you need to know on Bollinger Bands, W bottoms, and M tops. Understanding how these all play together can give you a solid strategy for deciding when to buy or sell an investment. In the next video, we'll look at the last indicator of this course, and that's Fibonacci levels. So thanks for watching, and I'll see you in the next video.